Picture this. It's the final day of tax filing. The clock is literally ticking down. But your client, the managing director of a major corporation, is stranded abroad on a beach. Or, perhaps worse, the company has suddenly been dragged into insolvency proceedings. The tax return is ready, the numbers are perfectly crunched, but who actually has the legal authority to verify and submit it? If the wrong person signs, the return is deemed defective, and that kicks off a cascade of compliance nightmares. It's a high-stakes scenario that pretty much every tax professional faces at some point. Welcome to today's Explainer. Today, we're diving deep into a critical compliance pillar of the new Income Tax Act 2025, Section 265. This is the section that dictates exactly who must verify a tax return. Whether you're a seasoned CA, a student, or a business owner, getting the precise legal framework for return verification right is absolutely non-negotiable. We're going to break down the statute, look at the accompanying rules, and clear up some of those common gray areas to make sure your filings are always legally bulletproof. Here's our quick roadmap for the explainer. We'll start with an intro to Section 265, then map out authorized persons by entity. After that, we'll hit some practical application and examples, cover compliance and common mistakes, and wrap up with key takeaways. All right, let's jump straight into Part 1, an intro to Section 265. For years, we've all had Section 140 of the old 1961 Act completely burned into our brains, right? Well, under the new Income Tax Act 2025, that provision has officially been replaced by Section 265. But here's the really good news, and this was recently clarified by the department's transition FAQs. There is no substantive change in how we verify or who is authorized to do it. The new act preserves a compliance structure you already know. It just streamlines the legal language and gives it a brand new home in Section 265. So what's the actual objective here? Why does the law obsess so much over a signature or an electronic verification? It boils down to one thing: strict legal accountability. When a return of income is filed under Section 263, the government needs a competent, legally responsible party to stand behind those numbers and declare, yes, this is complete and accurate. It's definitely not just an administrative checkbox, folks. It is the formal assumption of legal liability for that tax filing. Moving right along to Part 2, authorized persons by entity. The law assigns verification duties based squarely on the structural hierarchy of the assessee. Let's break it down. For an individual, it's primarily the individual themselves. For a Hindu undivided family, or HUF, the Karta has to verify. Now, when we get to companies, the law gets very strict. The managing director is the primary authorized person. A regular director can only step in if the MD is unavoidably absent or if there simply is no MD. You can't just pick anyone from the C-suite because it's convenient. You have to follow the statutory matrix. But wait, what happens to a corporate debtor under the Insolvency and Bankruptcy Code? Their board of directors is suspended, right? To solve this, Rule 168 of the Income Tax Rules 2026 steps in with a specific technical carve-out. It clarifies that for a company in insolvency, the authorized person to verify the return is the Interim Resolution Professional, or IRP, appointed by the adjudicating authority. This brilliantly ensures continuous compliance even when a company is in deep financial distress. Let's bring this to life in Part 3, practical application and examples. Let's circle back to our hook scenario, but apply it to an individual. Say your client is a non-resident or just happens to be absent from India during the filing window. Section 265 says the return can be verified by a person holding a valid power of attorney. However, and this is huge, there is a critical compliance catch. You absolutely must attach that power of attorney to the return. If you file with a POA holder's verification but forget to submit the actual document, boom, the return can be treated as defective. Scenario 2 deals with a more sensitive yet very practical reality: mental incapacity. The law is designed to ensure that tax compliance doesn't just halt if an assessee is mentally incapacitated. In these situations, Section 265 explicitly authorizes their legal guardian or another competent person legally acting on their behalf to verify the return. It's a vital safeguard, really. It protects vulnerable taxpayers while keeping them statutorily compliant. On to Part 4, compliance and common mistakes. When it comes to compliance today, let's be real. Wet signatures are basically ancient history. The term verification almost exclusively means electronic verification now. And the transition guidelines make it crystal clear. The core obligation to pay taxes and the modes of filing remain completely seamless under the new act. The tax systems are built specifically to validate the identity of the person verifying against the statutory rules we just talked about. Rule 165 of the Income Tax Rules 2026 lays out exactly how this electronic verification works. Think of it as a hierarchy. Step 1. For companies and entities requiring a tax audit,
A digital signature certificate, or DSC, is generally mandatory. Step 2. For others, an electronic verification code, or EVC, is fine. Step 3. This EVC is usually generated via Aadhaar OTP or net banking. The absolutely crucial takeaway here is that the person using their DSC or generating that Aadhaar OTP must be the exact authorized person designated back in Section 265. No workarounds.
Okay, so where do smart professionals actually trip up? Let's rapid fire some classic traps. First, like we mentioned, failing to attach the POA for an absent individual. Second, having a regular director use their DSC to file a company return just because they're sitting in the office, even when the managing director is perfectly available. The online portal might accept the upload, but legally, that return is invalid. And finally, treating Section 265 like it's a completely new paradigm. It's not. It's a continuation of Section 140, so your existing understanding of entity hierarchy is still the golden rule.
Finally, Part 5. Summary and key takeaways.
Let's distill this down into what you actually need to take back to your practice. First, Section 265 replaces Section 140, but keeps the exact same verification logic. Second, always check the entity type to determine the legally authorized verifier. MDs for companies, CARTAs for HOOFs. Third, remember Rule 168 explicitly empowers the IRP for companies in insolvency. Fourth, if you're relying on a POA, attach the document. And fifth, all your modern e-verification methods like DSC and Aadhaar OTP remain fully active under Rule 165. As automation continues to take over, we might actually see AI systems verifying basic returns automatically one day. But until that sci-fi future arrives, legal accountability rests firmly on human shoulders. So who in your organization is holding that responsibility today? Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.